Hey, real estate investors, imagine this for a second. You are sitting at the closing table on your dream home or your next big real estate investment, and your tax bill? It's thousands lower than you expected. Your deductions are bigger, your financing looks cleaner, and for once, Washington actually passed a law that helps you keep more money in your pocket. Sounds too good to be true, right? Well, that's exactly what's happening with what lawmakers are calling the One Big Beautiful Bill, a sweeping package signed into law in mid-2025 that's rewriting huge parts of the tax code affecting housing, real estate investing, and development incentives. This video is your complete breakdown of the 3 major changes hidden inside this bill that could change the way you buy, sell, build, and invest in property. And by the end, you'll know how to position yourself to pay less tax and build more wealth. So stick around, because some of these opportunities won't last forever. Let's start with the big one, SALT Deduction expansion. The first major change is something homeowners in high-tax states have been begging for since 2017, the expansion of the state and local tax deduction, better known as SALT. Before this bill, the SALT deduction was capped at $10,000. That meant if you lived in places like California, New York, or New Jersey, where property taxes and state income taxes are steep, you were losing out on tens of thousands in deductions every single year. Now, that cap is quadrupled to $40,000 through 2030. Think about what that means. A family in Westchester, New York, paying $28,000 in property taxes and $15,000 in state income tax, couldn't deduct most of it before. Now, they can deduct the full amount, wiping out a much larger chunk of taxable income. But let's move beyond just the math, because this isn't only about saving money on taxes. This change could actually stabilize housing markets in these states. Why? For years, high property taxes scared buyers away or forced sellers to cut prices. With SALT deductions restored, the net cost of owning those homes falls again, making high-tax states less financially punishing for families. In fact, analysts already predict this could add 2 to 3% to home values in some suburban markets where property taxes were crushing affordability. But homeowners aren't the only winners here. Real estate investors who own rental properties in these same states benefit too, especially if they elect certain pass-through entity tax workarounds, something we'll break down later. Now let's talk about homeowners with mortgages, because this one is huge. The second big change in the One Big Beautiful Bill brings back something many thought was gone for good, the Mortgage Insurance Deduction. For years, homeowners who paid private mortgage insurance, better known as private mortgage insurance, PMI, could deduct those payments. Then, in 2017, that deduction disappeared, leaving many first-time buyers paying thousands more each year. Now it's back, and the average homeowner stands to save about $2,364 per year, according to early IRS estimates. But here is where it gets interesting. This change comes at the same time mortgage rates remain elevated. That means many buyers stretching to afford homes will likely use lower down payments, triggering PMI in the process. With the deduction restored, the real after-tax cost of PMI falls, making ownership slightly more affordable at a time when housing costs feel brutal for many families. Picture this. A couple buying a $400,000 home with 5% down might pay $150 a month in PMI. Before this bill, that was just a cost of doing business. Now, a good chunk of that gets deducted, easing the monthly sting. And remember, when tax laws shift, lenders adapt. We are already hearing whispers about new mortgage products designed to maximize these deductions for buyers. Moving on to the third, and maybe the most exciting change for developers and investors. While homeowners got relief through SALT and mortgage deductions, real estate developers and investors scored big. The One Big Beautiful Bill made opportunity zones permanent and expanded the low-income housing tax credit program significantly. Let's start with opportunity zones. Before, these zones, areas designated for tax-advantaged investments, were set to phase out in the late 2020s. Now, they are permanent, giving investors long-term certainty. Even better, if you invest in rural opportunity zones, you now get a 30% step-up in basis after just 5 years. That means a big chunk of your gains could be excluded from taxes entirely, faster than before. Pair that with low-income housing tax credit expansion, which subsidizes affordable housing development through tax credits, and we could see a wave of new multifamily projects, especially in underserved areas. Here is what this looks like in practice. An investor sells stock with a $500,000 gain. They roll it into an Opportunity Zone apartment project. They claim low-income housing tax credits while also deferring or eliminating capital gains tax. For cities facing housing shortages, this could mean tens of thousands of new affordable units. For investors, it means stronger after-tax returns on projects that also carry a social impact mission. Let's tie this all together because the ripple effects are massive. We have talked about SALT, we have talked about mortgage deductions, we have talked about opportunity zones and low-income housing tax credits. But step back and look at the bigger picture. High-tax states could see stabilized or rising home values again. First-time buyers might finally catch a break with lower after-tax housing costs. Developers have long-term clarity to build affordable housing without fearing Congress will pull the rug out from under them in 5 years. Even the commercial market, struggling after remote work crushed office demand, might see conversions of empty buildings into residential projects financed through these incentives. So what should you do right now? If you are a homeowner, rerun your 2025 tax projections with the new SALT cap. Talk to your lender about how mortgage insurance deductions change your real cost of ownership. If you are an investor, look hard at opportunity zones in your state. Combine the low-income housing tax credit with cost segregation and bonus depreciation strategies for maximum impact. The One Big Beautiful Bill isn't just a headline. It's a blueprint for lower taxes, smarter investments, and potentially stronger housing markets. But laws are only as good as the people who use them. Book a free strategy call for the Real Estate Tax Strategy Guide at gavtax.com. See you in the next one.